Welcome to On the Spot. I'm Kevin Hill here with JP Hampstead, and we are going to talk about the spot market and trucking today.
Yep.
It's all about capacity still.
It is still all about capacity. We're still seeing tender rejections very high, above 22%. Following the hurricane, truckstop.com drive-in spot rates, the national average has moved up another leg to $3.60 a mile. Very, very high number. And we're seeing similar action in contract markets. Ocean rates continue to sustain at a very high level. LTL rates are similarly kind of stuck at a very high level, over $35 per hundredweight, the national average in our freight payments data. So, kind of all sides of the market are still very hot. And I think that when you look at the behavior of volumes, of rates, of the carriers themselves, again, it just goes to reinforce your point, Kevin, that it's all about finding capacity. The other trade-offs about service, transit time, visibility have fallen by the wayside.
Yeah, it doesn't matter, right?
Yeah.
It is. Transportation is one of those industries, the more you pay, the less service you get. I think we see that all around. Because the market's so tight, service levels do break down. And as you said, we were looking at Chicago before we came on the air. And Chicago is really showing that whatever space you can get, whether it's intermodal, LTL, full truckload, you take it. It doesn't matter. It doesn't matter. You better take it, whatever cubic space you can find.
Yeah, and we've seen data coming out of Chicago that suggests that shippers are really frantic. They are trying everything to get their freight moved. We've seen, I think right now intermodal tender rejections, which has to do with IMCs and railroads rejecting spot, essentially spot freight, is high for intermodal, but sort of normal now, around 5%, but there have been weeks in the past month where it spiked up to 17%, which to me is indicative of, a shipper in a jam that's just trying to move freight and, obviously like pushing buttons that no longer work.
You're exactly right. I was talking to a major auto manufacturer 2 or 3 weeks ago, and this is a well-known brand, and they are having real issues with IMCs, with finding capacity on the intermodal market. And this is a name, a company that should not have any problems finding capacity. And we talked about how difficult it was to define any kind of capacity whatsoever.
Yeah, that's interesting. I mean, right now, I think the automotive manufacturers are in a really big pickle. One thing that a lot of people don't realize is that for railroads like CSX, for example, which handle a lot of automotive freight, their intermodal contracts with UPS actually take precedence over everything, right? So like if they need trackage, if they need power, if they need crews, that's where it's going. And a lot of automotive shippers can suffer. They're actually facing shutdowns in the U.S. though, right? The GM is like pausing production at sort of all facilities, and we haven't. There's a little bit of a blip in our data from Labor Day, and that'll sort of work out over the next week as that kind of anomalous Monday gets out of our 7-day moving averages. But I haven't seen like a huge effect from the automotive shutdown yet. Have you?
I read an article, I think it was in the Wall Street Journal over the weekend or right before the Labor Day weekend, and Labor Day is traditionally a big car sales. You're moving out this year's inventory to bring in the 2022 models, and it surveyed a lot of auto dealerships, and they're going to treat it like they treated it like a normal weekend because they just don't have the inventory to support any sales. I mean, they're running thin. They don't need to get rid of the 2021 models because they're already gone because of all the raw material, all the supply chain issues, semiconductors. I know we've talked about that quite a bit as well. So you have all these factors moving in and pushing against each other. So
I think it's a preview.
Pausing production. I mean, that's what they have to do. We saw that on pack cars. On the semi trucks, is that they've stopped production. pretty well for the year, and they have, I think it was 4,000 to 6,000 trucks that are red flagged, waiting on parts to finish production.
Yeah, yeah, semiconductors and things like that. Although I should say that the shortages in the automotive supply chain are not related just to semiconductor suppliers, but they go kind of
all across the board.
Yeah, across the board. Back to what we were sort of talking about with the way that these modes are interacting, it's or not interacting. I just found it really interesting because in a normal freight market, right, converting freight from one mode to another can provide you with some incremental capacity. It can keep freight moving, give you a little bit more flexibility. And I'm talking about things like, putting a truckload move on the rail, or an LTL carrier using purchase transportation for its line haul to move things across regions faster, things like that. But there are these really important trade-offs that have to be considered by shippers when they're moving from one mode to another. A lot of those trade-offs have broken down, like we said.
Yep.
And so now, instead of this sort of modal flexibility providing extra capacity, a little bit more fluidity, it's simply just spreading capacity tightness, spreading equipment shortages across all the modes, and people are, plunging into LTL without regard to the fact that an LTL carrier may be trying to subtly tell them by changing the service requirements that like, we don't want your freight. Like they're blowing past those sort of red flags and just going for it. And I think because those trade-offs have broken down, we're seeing just persistent disruption in many modes.
We are. It's many modes. We started off saying 360 a mile, the national van average from truckstop.com. It's early September. We're getting into kind of the contract bid season. I know that it's all over the place right here. We're showing it right now. The 360 a mile from truck stop, and you see OTRI. I think whether it's 28%, 22%, anything above 20% is just tight, right? It's a tight market, and it's going to ebb and flow a little bit week to week and day to day. But we're talking about contracts, and some of the earnings discussions that we've heard is that trucking companies are still very bullish on 2022 rate increases in the double digits even. So with the spot market doing what it is right here on screen, going up an extra leg higher, that's very bullish for anyone in negotiations with new contracts, whether it's 1 month, 3 months, 6 months, 12 months.
I mean, trucking carriers are always bullish on contract rates. ExxonMobil always thinks the price of oil is going to go up, and your barber, well, maybe not your barber, but most barbers will tell you you do need a haircut, right? So it's, I don't know if you can, like, we'll see how that plays out, right, in the next few quarters. I do think that there's a lot of room to run. I mean, if you look at the state of the major markets in the country, they're as tight as they could be. Right. So if you look at Chicago right now, we were just talking about the truck stop rate to move a load from Chicago to Atlanta, 362, is right where that rate was in late February, early March, when Chicago was absolutely covered by a devastating blizzard. Right. So like right now, it's the same cost to move a truck out of Chicago as feet of snow on the road.
In early
truck
September.
Crashes everywhere in early September, should be the calm before the storm.
It should be, right? I think that's the amazing part. It's early September, and why is that? And there's many reasons for that, and we've talked about a few of those, but it's still just not a normal market.
It's interesting too, and before we go, I want to ask you this question, Kevin. I hear people say, okay, we expect to get some relief in spot markets, maybe in Q1 of 2022. Why do they say that?
Because they're kicking the can down the road because they've already
predicted the market to roll over, and now they're just kind of delaying that call.
So what I say now is the second half of 2022, because I don't see anything easing. So I'm going to kick the can down the road. I'm like, well, even if things, new capacity comes on board, new drivers come on board, freight volume, stimulus, infrastructure, you throw all these in a pot, you stir them around, you're like, well, nothing's probably going to happen for the next 6 to 9 months.
Right.
And in 3 months, it could still be 6 to 9 months, or we might see some early signs of a market turn. I don't know.
Interesting, yeah. So I think the point here is that really, regardless of your view of when the cycle will turn, the data is not there yet to suggest that there's any kind of weakening or softening.
Exactly right. And I think that's what the truck stop rates show. That's what OTRI shows.